foreign exchange, control policy, payment system design, and strategic planning. And Walker Todd has held the position of full-time lecturer in finance at Middle Tennessee State University. He was appointed trustee of the American Institute for Economic Research in October of 2014, and he has years' experience at the Federal Reserve Banks of New York and Cleveland. We're at a really interesting point in both monetary policy and regulatory policy at the moment. We're about a decade on from the financial crisis. The Federal Reserve is actually shrinking its balance sheet. And as we can see from some of the discussions in Washington, the collective memory of the crisis, at least when it comes to financial regulation, appears to be starting to fade somewhat. So I expect our speakers will have a lot to say on all those topics. And I think we'll start with about 20 minutes from each speaker. Then we'll have a brief chat amongst ourselves and then open it up for questions. So look forward to interesting conversation. Oh, by the way, I'm Matt Phillips. I write about markets for the New York Times. So welcome, and Tom, you want to come up?
Good.
Thank you. This is supposed to be idiot-proof, but here I am. How does this thing work? I see turn it upside down. That was, I think of that famous line in ideology, everything appears upside down. All right. Look, I want to begin by thanking the folks who staged this and organized it, from Jan and Randy on down. I have so many friends here, including on the panel. When they asked me to come, I said, okay, I'm going to do it. But I think I'll break away from one thing, which is everybody's been quoting Minsky, and I'm perfectly happy to quote Minsky. But the kind of talk I'm about to give, I think I want to quote the late, very not great, Frank Irwin. Now, Frank Irwin was the guy who Lyndon Johnson put in charge of the University of Texas with the specific instructions to babysit them and make sure he was never embarrassed. So in the middle of one term, he was having an argument with somebody who was then very differently perceived than he was later to be. That was one John Silber. And Silber finally said to Irwin, Frank, that's an obvious conflict of interest. And Irwin said to him, John, where there's no conflict, there's no interest. Now, I actually consider that the single greatest statement of American political economy ever. I mean, it's like it belongs in Bartlett's. I actually fished it out of the Boston Globe, and I still have the thing. But hey, so this is actually, I'm going to talk about Dodd-Frank. I'm just going to sort of walk you through where I think that story is at, trying to concentrate and trying to get done in 20 minutes. Look, this is also, unfortunately, a money and politics story. My main topic here is very straightforward. This is, if you remember, in the Iliad, the Stentor, the herald with the voice of 50, we're now in the thousands. I mean, we're there. And I've actually taken to calling this thing, because with two colleagues, I wrote a paper, 50 Shades of Green. This one is 50 Shades of Green, darker. And I want to just talk a bit about it. I'll end right where we are now, but with a kind of O. Henry ending, and then sort of. So, I don't want to spend a lot of time trashing out the existing scholarly literature. There isn't much of it, and it's not great, including some of the papers in the American Economic Review. Neen and Suki in particular seems to me a rather overpraised piece. I'll work up to that in a minute, but I want to begin with this reflection, which is the way you should do starting any discussions of financial regulation in America. You can see it. This is basically, think of that as finance, and think of this as the regulators, and you sort of get the sense of it, right? That ever since about 1970, things have just, the disproportion has gotten crazy. This leads, if you think about this for even 5 seconds, what I'm embarrassed to say, It was a Commodity Futures Trading Corporation commissioner who pointed this out to me, that what he was actually doing was running an employment agency for the people they were regulating. And you know, if you can walk out of your job and immediately make, or you know, after a decorous 6 month, 2 year, whatever time period, and make 7, 8, or 9 times what you're getting paid right away. Well, I mean, this just shows you that I don't read the Bible. Who was it? Elijah. One of them got carried up to heaven in a golden chariot. Golden chariots land all the time between New York and Washington right now. And you will notice, before we get into anything else, this has nothing to do with campaign finance. Nothing. All right, so when later I'm accused of overemphasizing that, I don't want to do that. The real story here is about the tumescent growth of inequality in a society. However, I need to just make a few points about campaign finance money, which I do a lot of. This formal campaign money is only a thin slice of this. There is actually a new paper just out about a week on foundations, which suggests that something like they've tracked carefully what foundations and, corporate foundations and similar things do with their cash, and they're finding absolutely stupendous. This stuff equals 40% of all reported lobbying expenditures, which are in the billions. I mean, so you're talking fairly serious money here. This was a point that was long ago apparent to me, because there was one really good Harvard thesis on this, on the just top 200 companies, and they found very huge amounts of money going into congressional districts, often to spouses and whatever. Anyway, this, however, we get to stuff that I and my colleagues Paul Jorgensen and Ji Chen do. This was the first time we discovered this, the linear model, and it was on 2012 data. And this is basically, you run the Democratic percent of two-party total money. That's a very different way of usually doing what gets done in political science. It normalizes out a lot of weird stuff. And then just take the differences there, and basically what you get is a straight line, which is as you go over 50%, you also go over 50% of the vote. And the usual reaction on this was, this can't be true. There got to be something like, the first thing was, this just can't be true. Period. It just, no matter what it says, it can't be real. And when we would show this thing to economists, everybody would laugh. When we showed it to political scientists, they got furious. And the suggestion was, well, what you really got is two-way causality. Well, yeah, you can actually test for that. As it happens, the 2016 data are heaven sent for that. But we did a very complicated latent instrumental variable model with spatial stuff. If you really, we can unpack it in the question period. Bottom line is, no, money turns out to be, in fact, the main driver, not polling. Now, a French scholar has just discovered this for French elections, 20 years of municipal elections and 20-some years of parliamentary elections, too. That paper's been published by the place I work at. I'm the research director at the Institute for New Economic Thinking. It's Julia Caget. But when we pushed this, our own study of the American stuff back, what we discovered is every single election for which we have data from which is only from 1980 on, looks like that. It's a linear story always, all right? And, you know, when folks were talking this morning and then at lunch, you know, about how you got the tax bill you got, yeah, exactly right. Now, I will come back to this, because remember, you should note, as you know who just bugged out, Paul Ryan, right? Now, what my colleagues and I did here is we took our data on the 2018 election, and then we sorted it into size of contribution, and then we plotted it by candidate. Now, I shall just, this is a one-line point, and that's all I have time for. We do a lot of things differently than the stuff you read in the rest of the scholarly literature or the press, because we spend a lot of time consolidating names and things like that. We use essentially modified versions of programs that hospitals use when they swallow another hospital and try to find out if they have the same patients or not. When you do that, you always find much higher levels of concentration than reported. I mean, they're enormously so, but that's another paper, another time. So anyway, if you look at this, you can see Bernie Sanders, in terms of, this is the smallest possible below $200 contributions. You will see Trump got a lot of those. But then he's kind of a barbell. He got a lot of big contributions too. Bernie Sanders effectively got nothing except small contributions. And I admit, I don't believe it. I'm tempted to say either. I mean, just assumption is there's got to be something weird here. There isn't. He was really running essentially a campaign on small money. It's the first time that I could ever see, and I've been doing this for many years before it was fashionable, and I'm sure I'll be doing it after, when democracy is only a memory. Essentially, I've never seen a really major national campaign run on just small money, and I don't believe that has happened in American history before. I have ransacked a lot of archives and things. Anyway, but you can see how Clinton actually has more big money than Trump. But now Ryan, which is what I direct your attention to here, what is Ryan saying as he exits? He says, well, you know, we have a piece of unfinished business. We need to repeal Dodd-Frank. And you know, we'll also notice he didn't do it. We'll come back to that. I will lay this out for many reasons back again toward the end of the talk. All right, now, the next step is I want to talk about the long war to change Dodd-Frank, how we know it happened, and just sort of crap on the scholarly literature a bit here, which keeps saying over and over, I had a dime for every time I was told this, I'd be, I won't be wealthy, but I'd be probably driving around in an expensive car or something. Anyway, the standard line in political science has been you can't prove that American legislators vote for money. And you know, my reaction to that has always been this is ridiculous, but I was usually working on something else. So when this was thrown in my face, I finally said, okay, I bet I can solve this problem. And I will just tell you what then I and my two colleagues, Jorgensen and Chen, did. Is we took all the Democrats who had voted in favor of Dodd-Frank originally. Then we took all those who survived Congress to vote repeatedly on whether to weaken. Now, this step is kind of, you know, it's different because it makes them into their own control. You can't, I mean, these are the same folks, same personal philosophy, presumably, same districts waiving small details. And so now you can look at all the time-varying stuff, having gotten them out of the way, right? Just to be sure we got them out of the way, we did put in a control for their personal inclination in that Congress. I can, if necessary, go on forever about this. But you know, what did we find? Well, so what varied hugely was cash, and you will be astonished to discover that the Democratic lawmakers broke ranks with their colleagues as the rest of them voted with the party against modifying. This is all U.S. House votes. There is a problem with the Senate, and you know what it is. There aren't many of them, whereas we've got hundreds of House votes there. And so what we found in this series of votes in 2013, 2014, and one in the lame duck session in, I think it was actually formally January 2015, money really talked. The other thing it did is if you were on the banking committee, you were much more likely to break with your colleagues. Now, there's a great paper out of, again, my place, I'm the research director, by Tahoon and Lent, Institute for New Economic Thinking. They show you how loans, personal loans to congressmen, if you get on finance, the Financial Services Committee, you double or triple your leverage within a year. Moreover, they can check that for the year before you come in, so you know it's not like all the high leverage people are making for the banks. In another paper, Tahun and Viberini, all right, they show you that actually in the TARP vote, these people were voting their pocketbook. If you were way down in the market, or your spouse was, you were much more likely, other things equal, even standardizing for contributions, which they, like most people, way mismeasure, but never mind. You were a lot more likely to vote for the bailout. And the other thing, when we checked around running all kinds of variables, yeah, if you were slightly conservative, and remember, these are Democrats. Conservatives in the Republican Party would actually work the other way. But in the Democrats, they're more likely to be, you will forgive my plain English, bank stooges, just by nature. They can't, I mean, it's sort of like, I think they can't help themselves. And then the other one I love is everybody who was leaving Congress that term, they were much, much more likely to vote in favor of the banks. Now, you will remember the fabled George Stigler article on why so many politicians were lawyers. And, you know, the Stigler answer was, you know, for which that I would have considered worth a Nobel Prize. The answer was that there were so many legal ways to pay them off. And, you know, it's hard not to see this was a special case of job search. I mean, in that I leave this to Pavlina and Randy to decide if they want to run this type of thing in one of their employer of last resort, think bank, and go on from there. Okay, good jobs and good wages, as Democratic presidential candidates are wont to say. Anyway, what I think my colleagues and I just showed bluntly is, yeah, there's been this long war against Dodd-Frank, and the basic way you did this was all the Republicans, I mean, they were so completely party alike, there never was any variation. I think 3 Republicans voted against Dodd-Frank, and in the subsequent, that same lopsided thing, highly partisan. But you break away on the Democrats, and you stuff cash into those, you know, who perhaps wish to be bribed or feel it necessary to be, whatever, and then you break it away. Now, this is kind of interesting because the latest bill that has just gone through the Senate got 11 Democratic senators' votes. I haven't done this study for them yet, but I bet I know what I will find when I do it. But at any rate, coming to that, I want to, point you want to make is that when Donald Trump, I'll come to, actually, is that, I hope, yes. I'll go back. The large bank position on Dodd-Frank got fairly careful fairly early. And they don't actually, most of them are not seeking absolute repeal. Diamond is a case. And you'll note the timing on that. That's right after they discovered, my God, we might actually get everything we wanted. And bank stocks were actually, I think they rose about 20% right after the election. Anyway, what publicly stated, they want the stress test modified. That's really, you can do that through some new Fed directors, and they've clearly done that. I mean, the capital requirements will get, you know, the Volcker rule, unspoken. Nobody, neither Diamond nor anybody else gets up in public and says we're going to gut the Consumer Financial Protection Board, but have you noticed what's happened? Anyway, the next step was sort of like, what was the deal with the Trump administration? Well, there, my colleagues and I have a long paper. It's out on the INET website in 2018. Basically, what we found is this. The first part, down to the primary end, Trump financed his own campaign. What a surprise. And as late as May, he was saying he really didn't need money. Then came June, when you actually have to sort of like have to put the convention together and start raising funds with the Republican National Committee, and they changed their line. We basically created a day-by-day file of incoming cash, which we can tell you exactly where it came from and who got it. Here it is. This is the convention. This is later. We'll get to that. Here's what you need to know. That's what you need to know, which is at the time of the convention, the banks began to pour in large amounts. And you know, we catch not only the political action committees, but the individual contributions of folks, and whatever else they're writing, 527s and things like that, or grants to the convention, contributions to the convention gang. They're all in there. We do not catch charitable grants, but you know, that's a nothing is perfect, not even our work. Anyway, my point is simply, where are we headed then? You'll notice what Diamond said. He didn't say anything about derivatives in that, especially after they modified the swaps push-out rule successfully with all the cash into the Democrats and again the Republicans in the that January 15 lame duck session. We will shortly publish a paper by Michael Greenberger. It's a terrific paper in which he shows you what actually happened on there. Thanks to the Commodity Future Trading Commission reissuing some rules, basically everybody's moved their main derivative stuff offshore. And so what's left for this, folks? We have a modified bill right now. Or pardon me, we have one Senate bill passed which did some exemptions, not that much for big banks in the end, though there's some dispute about some language in that. There is now a House version of the bill with the people who really want to just go whole hog, I use the term quite advisedly, and just repeal Dodd-Frank. They're sitting there. They're not the same, but presumably something, I mean, I was listening yesterday to an optimistic guy who was trying to stop it in Washington. He's saying to me, well, the 11 Democratic senators who voted for the bill are saying they won't accept any more Republican changes. Otherwise, they'd vote against it. I'll believe it when I see it. I mean, I've watched this kind of stuff for a while. And, you know, maybe they will and maybe they won't. But 11 senators breaking away is a lot. And so, as we close, I bring you to this thought. It is not the case that you have the sort of, what might be thought of as the perfect bank scheme yet. Because Dodd-Frank did put a crimp, although when you start to read the fine print, it turns out there's a hole in it, which we can discuss in the question period if you want, on bailouts. But the failure to sort of clearly say, to green light big bailouts has bothered a lot of people. Ed Kane has done a series of papers for INET where he shows you how stock market prices and debts of banks get capitalized, this too big to fail protection right into it. And there's still plenty of that around, though I don't have any current estimate. And as system risk goes up, and you know, there are big increases in auto loans, student debt, and student auto, what am I missing? Mortgage credit again. Subprime stuff is again, I mean, you'll see the system indices will go up and those premiums will rise again. But that brings us to the discussion high in the clouds where Tim Geithner, you remember him, is proposing that bailout discussions need to be really redone, and that it's really important to keep the financial system going by preparing ever bigger bailout legislation. You'll be hearing from this in the near future. You can also see the problem. I guess I get my last, yes. I actually want the fiscal capacity. The problem here, you can see this. Now, there are some papers on 2008 by various organizations that show you there were when people in some countries, as they began to bail out banks, if they also bailed out, I'm going to speak very loosely, if you bailed out the rest of the population too, they sold bank stocks. Put bluntly, that the fiscal capacity there's something that people try to preserve. You will hear this a lot more, but you should think about this in the next couple of years, because it's obvious, exactly as a number of you suggested this morning, that the huge tax cut, you know, is going to give you some big big deficits. It doesn't matter. I'm not a deficit fanatic. I don't think the world ends when you have a deficit and stuff like that. But these will grow large, and the pressures to do something for the rest of the population will be intense. This is sort of an interesting discussion. I don't think it's over yet. And I expect to see more shoes drop. We know now from papers done, again, you can read some accounts of those on the INET website, that the top bank officials in the leading banks were actually selling their shares of their own and other bank stocks as they were putting their institutions through the final phases of the thing that led to the blow up. It's impossible to overstress just how sort of completely lax the regulatory requirements really are here, that people get rewarded, as Ed Kane says, for finding new ways to sort of go leverage your institution, get undetected, and run up ever more. All right, on this happy note, I leave you. This is, to paraphrase the famous old Trustee line, you may not be interested in history. The history and bank bailout specialists are interested in you.
Well, thank you for the invitation, and I'm going to take a slightly different tack and talk to you about money and innovation, central banks, and I'll end up with monetary reform and Minsky. So if you bear with me, I'll take you on a little tour here, partly as a background. I should say I've been with the Central Bank of Norway for 30 years. I'm retired. I've been consulting recently for them on a project on central bank digital currency. So I'll talk a little bit about cryptocurrency, central bank digital cash, and then end up with monetary reform. So we'll see how that goes. So what is the direction of these?
To the right.
To the right. Okay. Just as we get this in the setting here, I just wanted to start with where we are. The annual meeting of the IMF started this morning with the publication of WEO, and I just put up a quote here from FSB from March, and so the consensus seems to be like, we are in a pretty strong growth environment, and there is this distinct feeling that, the regulatory reform that was started after the crisis is somehow about to be ebbing out. This is also a quote from the FSB letter to G20 recently. At the same time, as somebody showed earlier, leverage is high, debt is high, and we are at sort of a bit of an uneasy point in the cycle. So before I start going into the crypto story, I just wanted to say briefly here that we seem to be in a period with a bit of regulatory fatigue. Basel 3, 4, 5 is about to sort of being discussed. But as was just mentioned here, in the US there is definitely a bit of a roadback. Slow growth is accepted as a new normal. Low rates is driving shorts for yield. Exchange traded funds and many other funds are reaching record highs. And there are new speculative asset classes that emerged, including cryptos. And it's a big discussion. I won't go into it in much detail. But I want to sort of point out that the regulatory focus has somewhat shifted from what we might consider important issue to issues related to fintech and crypto. And this is the background for central banks' recent interest in studying this themselves. And what I'm going to reflect a little bit about is whether it's a good idea for central banks to start issuing digital cash. So what I'll do is we have 20 minutes, so this would be pretty brief. I go into a little bit of challenges and opportunities of cryptocurrency. I'll talk about different concepts of digital cash from central banks, and then I'll contrast two schools of thought: one that favors this, one that are opposed to it, and then I raise just a few key policy issues that are deeper and actually is in large degree related to the role of central banks generally, the role of central banks specifically in credit allocation, the question of who should have access to safe assets, and then again end up with a case for monetary reform. I mean, if you follow the crypto space, there is just too much to comprehend, and there is daily new official reports. There are many good reports by the BIS, for example. FSB and G20 has recently discussed this, and what I've listed here is just a couple of the arguments that G20 listed recently in terms of challenges of this new sort of cryptocurrency area. And you can see there are investment protection concerns, financial instability, systemic contagion, money laundering, terrorist financing, the whole lot. I think it's fair to say that the current sort of official position is twofold. One is, you might have noticed that there has been a shift from discussion of cryptocurrencies to crypto assets. And this is deliberate because G20 recently was very clear, stating that these cryptocurrencies, private cryptocurrencies, don't have characteristics qualifying as currency. And they are instead labeling them as crypto assets. So there's a big discussion about how to regulate crypto assets, and some countries are more restrictive than others. And that's a big discussion. I won't go into it here. But then you also know that there are a lot of people favoring blockchain, or the underlying technology of cryptocurrencies. So that seems to be sort of the position coming out of the official discussion. And I just found a quote from a speech by Mrs. Lagarde yesterday, actually, where she says that fintech revolution will not eliminate the need for trusted intermediaries, brokers and bankers, but it's the technology, the distributed ledger technology, that could be productive and could be used in many other ways apart from currencies. But just to go back to my previous slide here and say that one point I didn't mention, and many of you know and recall discussions of dollarizations in sovereign states, and that's really a key aspect that has led many central banks to start looking into this, because you see sort of private or external currencies encroaching on your national domain, and you want to be prepared. So I just give you 3 short slides on things happening. There are almost new initiatives coming up each day on private cryptocurrencies. This is an interesting one because you might notice that there are 2 famous economists there, Frankel and Scholz, and everybody would say that they haven't always been successful. Some of you might remember long-term capital in '98, but anyway, these guys have now subscribed or sort of sponsored this Saga token, which is some new form of cryptocurrency based on real currency. So Financial Times had a good story where they said that what's the use of it? Why don't they use regular currency? There was this very interesting small island state that actually has reportedly issued sovereign cryptocurrency in initial coin offering, which is the term for going public on these things. And as you can see, it's a 50-50 split with an Israeli company who takes a lot of the money and runs. But the other interesting thing here is actually that they're preparing to use the proceeds from the initial coin offering for good causes. And it reminded me a bit about early American monetary history, where some of the way you financed wars and the army and stuff, or other public goods, was by issuing money. So nothing is new under the sun. Some of you might have noticed, if you follow this, that there was a system in Ecuador which actually got quite a lot of publicity as the first, or one of the first public or central bank digital currency schemes. If you know Lawrence White and you see where he comes from, he's very happy that it failed. So he said, this is, you can't trust central banks to do these things, and you can, better just stop this practice. Anyway, it's a lot of things going on, and obviously the question posed by many is, whether this classical tulip bubble, bubble, or whether it's something really going on. And as I said before, the shift in language is interesting. G20 notes again that crypto assets is distinctly different from currencies. So this is the background for the recent initiative by many central banks to study whether they should actually issue their own electronic cash. So you would have electronic legal tender. And this started initially with some banks in the forefront, like Bank of Canada, Bank of England. The Riksbank has been quite high profile in this, and I'll come to that in a minute. I come from Norway, and Sweden, Norway, and some of the Nordic countries in Europe are emerging into a cashless society. I mean, I personally literally never use cash, and most people go without it. So the question then is, and then there are a lot of others, so I won't go into detail on that. The question is, which type of digital currency can we conceive of, and then what is the motivation, and what would be the result? Obviously, there are many different motivations for this, and I won't go into detail. This is just a picture of a BIS report, really good report if you want to study this. They cover most of the ground, but I think, broadly speaking, you can say that there are developing countries issues, there are countries that want to sort of do this as a way of financial inclusion, which is a legitimate ground. Then you have cash-less type society like Norway, Sweden, and others. And then you have a lot of other things like ROGOs, negative interest rates, and so forth. But I think when you start looking into this, it raises important issues in terms of who should do what in the monetary sector, who should issue money, for example. It's a question that has been dormant for a while, but suddenly people are sort of waking up to the question of, well, is it fair that commercial banks should issue most of the money, and then that the federal government would only issue paper money or cash? And could it be otherwise? And there are, by the way, a lot of newly written good books about the history of this. So before I move on, let me just say that there are different ways electronic money can be made available, and many would say that central banks already have electronic money, digital money, in that they make it available to banks on account with them, and then that raises a very sort of classical discussion in central bank circles about who should have access to central bank accounts. And an issue that has been raised recently is, well, if the public should have access to electronic money, wouldn't that mean that they would need access to the central bank accounts on par with, banks and other intermediaries? And so you have, variation of this. It could be, simple tokens, and it could be, other forms. It could also be operated directly by the central bank, or it could be outsourced, typically. And then, well, my favorite, I'll come back to that, is, it need not be central bank run at all. It could be a state bank. So you would have a, state liability rather than a central bank liability. So these issues are being discussed. And then, I think there are a couple of key issues here that are of broader significance and not just related to this sort of digital cash issue. This is a quote from Stefan Ingves. He is the governor of the Riksbank, and they have a report which I quoted here in the footnote. But he's basically saying and asking the question, well, to which degree is the payment system to be considered a public good, or should we leave it completely with the private sector? That's a key issue. You could say that, the central bank is obviously the core of the current system with the RTGS and Fedwire and all that, but he's questioning, whether, the retail part as well should be completely in private hands. And I won't go into detail here, but these graphs show some of the developments related to the cash use in Sweden, and it's diminishing quickly. And as you can imagine, for a central banker, there is immediate concern in terms of what happens if the private system breaks down, and what is the alternative. And we used to have an alternative in the form of cash. So we had storage facilities, we had different agreements about how much cash they should keep involved in case there was a disaster of some sort. But with cash now very much less in use, that becomes a bit of a weird notion that if there is a crisis, you won't have that infrastructure anymore. And so then the question is, well, what do you use then? Let me just point out one other point here, which is that in their initial thinking, the Swedes have considered this to be interest-free money, in the sense that you wouldn't want to give the public access to interest on those monies. But there is a big discussion in terms of what might happen in case of a crisis, and you could have wild swings from commercial bank money into central bank digital cash, and there are clearly people concerned with the implication of that. I think I skipped the Swiss one, but just moving on to the two tabs. In the Nordic countries, we have friendly discussions about these issues, but it's fair to say that the Danes has been on the very opposite side of the Swedes in a sense. And this is from a recent speech, and they also have a report where they said a CBD, central bank digital currency would be a solution to non-existing problems. And basically what they're saying is, why should we care? We have a perfect, and I should add that the payment systems run over commercial bank money is very efficient in our countries, and has been for a long time. So you could argue, there is no need for any public intervention. So you can see the public-private discussion here coming up again. Ingves and the Swedes on the other side say that the e-krona would give the general public access to digital complement to cash. It would enable people to make a choice, so you wouldn't be dependent completely on a commercial bank, even though if you have deposit insurance and all the other things that so-called make your money safe. So I'll wrap up with raising some bigger issues in terms of what this discussion, because you could argue that cryptocurrency is a bubble and it would be gone in a short time. Blockchain technology probably will remain and will be important in the new technological revolution. But then the question is, should these issues remain regarding central bank taking a new road? And this is a quote from Mark Carney of the Bank of England, who recently had a good speech where he addressed some of these things. And I think, well, he didn't take a stance, he just raised the issue. I would note that a general purpose CBDC could mean a much greater role for central banks in the financial system. So it means if you want the central bank to have a much greater role, you have an opportunity for that. Central banks may find themselves disintermediating commercial banks in normal times, and then again running the risk of destabilizing flight to quality in times of stress. This is a very, very central discussion currently going on in these central banks. What I would say is that it's interesting that the discussion raises some very fundamental questions that could come up in other contexts regarding, for example, to the lender last resort role that was just alluded to. But here you can see that if suddenly you give the public an opportunity to put their money in the central bank rather than commercial banks, there will be base money implications. So you would have to think, well, should you intermediate the base money back to the banks in form of discount money, discount lending, or should you do open market operations? Or maybe even the central bank should take on a greater role in providing investment and providing money to the people through that more older way of engaging. And then again, the question of reserves for all. I mean, is it fair? Would you want to have your money in the central bank? In which form? And many have argued that the Fed already has extended the access to save money through reverse repos, another mechanism, and so this would be a natural extension, right? But some argue very, very strongly that this would be a slippery slope and should definitely not be engaged in. In Europe, there is a discussion related to the question of who should issue money. I won't go into it here. You might have heard about sovereign money. This is a report by Positive Money in the UK, and the key question they raise is it fair that our money should be primarily issued by banks and again not by the central bank, and this is particularly relevant again for countries like ours where cash is about to disappear. And then the question is, what would the central bank's role be? Should they issue digital cash? Should they open accounts with the public? Should they perhaps only issue tokens that could be used instead of cash? Obviously, the question of anonymity is key here, in addition to whether you would have interest. But you could also see that it opens up certain interesting questions regarding whether a more active role for central banks in terms of not necessarily operating into the traditional sort of independent central bank inflation targeting environment, but taking on perhaps a more active role. And it would certainly require more coordination between the Treasury and the central bank than is normally considered today. I just like this to reintroduce mentioning this again, the postal bank, which I think is an interesting thing in terms of there is a current campaign in the U.S. With this logo, but I also contrasted with Tobin's quote from Tobin's famous 1985 paper preceding his Jackson Hole paper from 1987. Where he says, allow individuals to hold deposit accounts in the central bank or in branches of it established for the purpose and perhaps located in postal offices. So I'll end just with a quote from Minsky, because I think some of these questions are sort of bringing up some, some connotations to the broader discussion of monetary reform. And these are quotes from a paper he wrote in 1996 at the end of his life. Essential prerequisite for good financial society, a central bank that prevents debt deflation through its never last resort powers, which we'll hear more about, more qualitative credit controls and direct credit towards socially desirable activities, a national network of community development banks, which he favored, and a return to early post-war policy of low and stable interest rates. And finally, just as we talked about investment here in the morning, Minsky's case for monetary reform, we need to establish and enforce a good financial society in which the tendency by business and bankers to engage in speculative finance is constrained. So, thank you for
some preliminary remarks before we go into the slides, but let me get that out of the way first. It's indeed a pleasure and an honor to be back once again for the Minsky conference. Somebody asked me earlier, when did I first come? And I think it was back around 1991. And Minsky, of course, was personally running the conference in those days. So anyway, here's what I wrote. Ideally, at a time when Jan Kregel and Randy Ray or Larry White or Kevin Dowd were available, I would be allowed to hold forth on the theory of lender of last resort. There are three main branches. One, there's a classical theory. In the classical theory of lender of last resort, there wasn't any. If you go bust, you go bust, and welcome to the bankruptcy court and all that stuff. There is an establishment view of the lender of last resort, which sort of is the way we've been governing ourselves in this area for the last, 100 years or more. The establishment view essentially takes as gospel what Walter Bagehot wrote in Lombard Street in around 1872. And then there's a third new branch that has emerged primarily since the early 1980s at the Federal Reserve, and in spades and spectacularly since about 2008 in the crisis. I call it the Gonzo Fed, which will now lend to anyone on just about any security whatsoever. I think I nailed this topic in the slideshow we'll see here in a moment, in a talk I gave last summer at the Western Economic Association meeting in San Diego. Too many monetary economists think that whatever the Fed does as lender of last resort is all right as long as the monetary aggregates come in at the intended target. Keynesians tend to say that an ocean of monetary aggregates is irrelevant as long as aggregate demand comes in at the intended target. Lawyers tend to say that the lender of last resort process is sort of like bankruptcy, and that procedure and rules therefore matter regardless of monetary base or aggregate demand. So which of the blind men grasping which leg of the elephant is correct? And the answer is all of them, but only if each takes account of the other's perceptions. Monetary expansion is all right, but it needs to stop when it no longer is achieving its desired effect. Regarding our recent experience, I would say it is time to land the helicopters. Okay. Aggregate demand stimulus can be all right, but it is difficult to see how monetary policy action, as opposed to fiscal policy action, can stimulate demand effectively in a declining nominal interest rate environment or in a flat to declining real interest rate environment. The lawyer's rules-based objections are correct, but unfortunately, political actors always want to override the classic rules that govern insolvency and bankruptcy. My view, and my old friend and colleague in co-authorship, Anna Schwartz, by late in her career, 2008 in this case, my view and Anna's was that it is the mere existence of the Fed's discount window that tempts everybody concerned toward abuse of the lender of last resort. The only sure and lasting reform is abolition of the discount window, relying instead on open market operations for monetary policy and careful surveillance of what the open market desk is doing with that mandate. In an emergency, the only discount window activity permitted should be modeled on the term auction facility, essentially auctioning off temporary liquidity assistance, emphasis on both the words temporary and liquidity, and auction it off to the highest bidder. At this conference, you would expect to have somebody point out that Minsky preferred to have the Fed carry out monetary policy operations through the discount window instead of open market operations. And one of his main rationales for that was to enable the Fed to inspect exactly what kinds of assets the banks were holding on a near daily basis. In the world that existed when Minsky first wrote about this subject, and that would be the late 60s and early 70s, his approach did have theoretical merit. I personally benefited from that practice at the Fed in those days. I benefited in knowledge, not money. from being able to inspect the commercial obligations that were being brought into the New York Fed discount window just about every day for the better part of a decade, from the mid-70s to the mid-1980s, in my role as the principal in-house lawyer for the Fed's discount window. I tell my classes today that I have probably seen more real bonds than anyone still alive, because I was seeing what the banks were bringing into the New York Fed every day at the discount window. And when I left New York in '85, the transition had already begun to electronic issuance of bonds and away from the real thing, so that all my successors in New York have not seen anywhere near the number of bonds that I have seen. But alas for Minsky's and my views about the window, especially after 1984, the Continental Illinois failure, that older world at the discount window began to disappear at an accelerating rate. In subsequent decades, it became clear that for the Fed at least, the types of paper that banks were generating no longer mattered very much, and the quantities of bank credit being generated no longer seemed to matter much either. Instead of maintaining an honest capital adequacy or loss-absorbing cushion, banks and their supervisors have increasingly come to rely on risk-adjusted capital, culminating in Europe in 2011 with the revelation that European banks were counting the bonds of Greece and other southern periphery countries in the Eurozone as attracting a zero risk weighting, because they were, after all, full faith and credit obligations of the respective sovereigns, each of whom was in some danger of default. In the late 1990s, large banks in the United States began to make large loans intended to fund subprime lending activities. In some cases, they outright sponsored or owned off-balance sheet entities that made such loans. Check out who owns payday lending firms today, for example. They're somewhat controversial in the consumer finance world, but nobody ever asks the question, who are these guys? Are they Russian oligarchs? Are they Chinese investors of flight capital? Or is it JP Morgan and Bank of America? Why don't you ask the question and find out? Today, the Fed's balance sheet is still bloated. It's about 4.4 trillion instead of the 900 billion or so that was there before the crisis. And the balance sheet is chock full of things that neither Minsky nor I ever dreamed of. There are today zero regular discount window loans. Fed calls it primary credit today. And there is essentially no capital left at the Fed. System-wide, the capital is 0.90%, and at the linchpin, the Federal Reserve Bank of New York, it's now down to 0.52% capital. So back to my opening paragraph. How much time do I have left? 5 minutes. Let's do what we can on the slides. This is an important point. I'm teaching currently in my hometown university. My father taught there for 26 years, and I attended there a couple of summers myself. Okay. The paper was called The Constitutionality of the Fed's Lender of Last Resort. I was asked to do this paper. What does the Constitution say about this matter, as though anyone cares? Well, the lender of last resort is often poorly understood and miscommunicated term. Economists primarily are concerned, after all, with the quantity of monetary injection by the lender of last resort, usually in the form of new reserves, when the central bank is doing it. Lawyers and most politically attuned laymen primarily are concerned with the structure of and legal authority for lender of last resort operations, by what right do you bail him out and not me, for example? Both concerns matter, and it's a mistake for each side to ignore the other. The Fed's lender of last resort authority is in Section 13.3 of the Federal Reserve Act, last amended by the Dodd-Frank Act in 2010. It requires a supermajority vote, 5 governors, to declare a financial emergency in unusual and exigent circumstances in which the Federal Reserve banks may make loans on any satisfactory security or collateral to individuals, partnerships, and corporations. Well, that's just about anybody, and with the right degree of application of political muscle, the acceptability of collateral can also be just about anything. AIG was really on the ropes, for example, in '08. And to secure the loan to AIG, the Fed took a pledge of the common equity shares of AIG and then turned around and lent them $80 billion against that. This was a failing institution whose common equity would have no value in the event of bankruptcy. The Section 13.3 was added to the Federal Reserve Act in '32, but this was done as part of a stimulus measure at the time, a road building act. And it was also unclear at the time how the responsibilities between the Fed and the later Reconstruction Finance Corporation, how they were to be divided. It later proved that all this stuff should have been done through the RFC, and the Fed had this lingering authority, and once it had that authority, it was reluctant to give it up, whether it was used or not. And in fact, this authority was not used after 1936 until we got to 2008. Okay, the 2010 amendment in Dodd-Frank essentially removed the restrictions that had been there before on the kinds of collateral that could be used. By removing those collateral restrictions, for the first time, the act permitted the Fed to make bailout loans to securities firms. Securities firms previously did not hold enough of the right kinds of collateral to do them much good in a crisis. During the crisis, the Fed always cited Section 13.3 as the legal authority for whatever it was doing. I believe they created something like 13 special lending authorities. In 13.3, whenever Bernanke was asked, what's your authority for that, it was always 13.3, that lets us do whatever we want. The Fed, you're taught in the textbooks that the Fed conducts monetary policy by buying and selling, say, government securities in the open market, usually under repurchase agreements. There have been zero repo transactions at the Fed since January of '09. And until the beginning of QE in mid-year 2009, virtually the entirety of monetary policy actually was emergency lending plus the exercise of foreign exchange liquidity swaps with foreign central banks. Nobody ever talks about that, by the way, but the Fed lent $600 billion, that's billion with a B, to the central banks of the world, primarily the European Central Bank, Bank of Japan, and the Bank of England. Okay. The current outstandings under the ECB swap lines are about 35 million in any given week. I don't know what they are today. And they're usually for only one or two banks. At a prior conference here, I cornered an official of the ECB once, and I said, why is it that week after week I see this one bank showing up to borrow under the swap line, and it's always 20 million here, 30 million there? And I mean, don't you guys have that much lying around as loose change? Why are you borrowing that from us? And the answer my friends would put out was, maybe the risk of that borrower is so bad that even the ECB doesn't want to touch it. You ought to consider that. Walter Bagehot is frequently cited as the basis of the way the lender last resort activity is conducted. His book, Lombard Street, 1873, in the American edition. But he was British. He was writing 100 years after American independence. There's no way Bagehot's views got incorporated into the Constitution. Peter Connie Brown of Penn, in 2015, wrote a book called Power at the Fed. And in that book, he does one thing that I commend. He quite properly challenges those purporting to quote Bagehot to quote all of the relevant passages, not just the passages they frequently manipulate to justify what they're doing. The most common manipulation is, in a panic, discount freely, lend freely. Well, what about the collateral? Oh, well, I guess it should be any reasonable collateral. Well, what about the reasonable collateral? Does it have to be something that actually has market value? Ah, yes, grudgingly, I'll admit that. And what about the interest rate? Should it be at regular rate, subsidy rate, or penalty rate? If you tie my hands and put a rope around a stone and drop me in the water, I guess to avoid that, I would say penalty rate. But otherwise, I want to subsidize it or charge no more than regular. In the 2008 crisis, the Fed was charging an alleged penalty rate for its bailout loans. They were charging a couple of points above the regular discount window lending rate. When Goldman Sachs went to Warren Buffett and borrowed $5 billion, what rate do you think old Warren charged Goldman? 9. The Fed would sooner die than charge an investment bank 9%. Say, what does the Constitution say? The only relevant clause, well, the first point 1 is important. The economist Willem Bider, who at the time was the chief economist at Citibank, some of the people in this room know him, wrote an article in 2009 challenging the Fed's procedures under 13.3 on the basis of the appropriations clause of the Constitution, which says, no money shall be drawn from the Treasury, but in consequence of appropriations by law. Congress has to vote on it. And a regular statement on account of all receipts and expenditures of public money shall be published from time to time. There needs to be, in effect, a GAO audit and a report to Congress. Any of that ever happen under the Emergency Lending Authority of the Fed? They fought it tooth and nail. Finally, in Dodd-Frank, we got limited audit authority, limited only to the emergency loans occurring between January of 07, I think it was, and year-end 2010. That's all that's ever been audited. I was asked by a House committee staffer, can you accept that? And I said, yes, I'll accept it, because if you do that, enough dirt will come out so that there will be constant ongoing pressure to have a more generalized ongoing audit. So essentially, emergency lending is just a backdoor way of funding the Treasury without appropriations. Otherwise, the Constitution is silent on central banking. Does the word central banking exist? No. Are the Fed's emergency advances authorized expenditures? No. There's no appropriation, no authorization, no numerical limit. What do Madison's notes on the Constitutional Convention say? The relevant passage is September 14 of 1787. They are not binding legal authority, but they amount to expert opinion. So here was the relevant passage from that day. Franklin introduced a provision after giving Congress the power to cut post roads and have a postal system, the power to cut canals where deemed necessary. Then there was a discussion that followed saying, well, canals, couldn't we charter a corporation to run the canal? And others started objecting, the minute you charter a corporation for any purpose, people will think it'll be converted into a bank, and you know how people feel about banks, and you hear the rifles being cocked in the background. So Colonel Mason, George Mason at the bottom there, says, I am for limiting the power to the single case of canals. I am afraid of monopolies of every sort, which I do not think are already implied by the Constitution, as opposed by Mr. Wilson of Pennsylvania. Wilson had argued, well, you know, the government has the power to regulate trade, therefore it could create a monopoly. The motion being modified by Mason's motion to admit a distinct question specifying and limited to the case of canals. The vote was 8-3 against. The states had to vote as units. There's 3 states voting in favor of the canals, or arguably a power to charter a corporation. The states voting in favor were Pennsylvania, Virginia, and Georgia. Everybody else voted no. The power rejected, Madison wrote, the other part, the power rejected, fell, of course, as including the power rejected. No power of Congress to charter a corporation. So what's the Fed? Conclusion. It's a bad idea to have lender of last resort activity in the central bank under the U.S. Constitution. Regular discount window lending could be tolerated if run only in the term auction facility model. And the European Central Bank does do that, by the way. It most of the lending it puts out is through a term auction facility. And Congress, meanwhile, does have the power to charter a lender of last resort or an agency to do that, fully subject to appropriations, oversight, or audit and review. The RFC, for example, was such an entity. The Fed was not and is not. It resists appropriations and review. And I told you already about the audit provisions about the 2008 loans, and Dodd-Frank then in the aftermath requires a lagged but quasi-contemporaneous report to Congress and full retrospective reports on any emergency lending going forward. Economists need to be more aware of the legal, structural, and even constitutional issues regarding lender of last resort activity. And lawyers and members of Congress and their staffs need to be more aware of the quantitative and monetary policy implications of lender of last resort activity, and they need to intervene when appropriate through lawsuits, audits, reviews, oversight, if the economists are running off the rails, which they clearly did in 2008. With that, I stop.
I'd like to thank all of our panelists one more time. It was really excellent and wide-ranging discussion. I'm going to ask a couple quick questions, and then we'll open it up to the floor. You know, it was a pretty broad discussion, covered a lot of ground, but there was one thematic thread that you could trace through the entire discussion. That was the political power of the financial institutions and the banks. You know, whether it's in the case of offering exorbitant salaries to ex-regulators, they would clearly have something to say about disintermediation of the financial sector. If we go to a crypto-based system, clearly they have a lot to say about the elasticity of the lender of last resort function. So maybe I'd love to hear what all of your thoughts are about what we've learned about the political power of the financial sector over the last 10 years, given that we're once again seeing a push towards rollback. Were there missed opportunities, and what could be done in the future?
Two main things. Picking up on Tom's general theme, you might require as a condition of any vote on financial legislation that those voting disclose their campaign contributions from the financial services industry. And that might or might not act as a deterrent. If you think Washington is just a hopeless swamp, you would say it still wouldn't do any good. They would disclose their multi-million-dollar contributions and go sailing on over the cliff. When Dodd-Frank was enacted, I asked Tom, by the way, when you get a chance to comment on the quality and quantity. We saw the McConnell and Ryan contributions here. What were they like for Dodd and Frank at the time, back in 2010?
I have two reflection and actually a question for Tom also. You know, I talked about this, you know, crypto space and the role of central banks, you know, I think all of us here are familiar with the role of commercial private banking and their strong impact on the design of the system. But what I would sort of say is that the discussion currently going on, especially in Europe, regarding these issues of especially of digital cash, I think opens up a discussion, a potential discussion about, you know, the role of commercial banks versus the public in some of these areas that we haven't had an opportunity to do before. And I think there are literature coming out pointing out that it need not be this way. Okay? It sort of raises the question that, you know, why should the commercial bank, you know, run the whole system? Why should they issue all the money? And to me, this is an opportunity that, you know, raises, you know, or can be used to sort of raise broader issues that I try to make. I have one question to Tom related to funding and Dodd-Frank. I come from Europe, and as you know, the funding political election, you know, picture is much different. Nevertheless, we have gotten enormously complex financial regulations. You know, Basel regulation is just an example. And I think the most important graph you had was the first one. Regarding the salaries in the financial sector and in the regulatory sector. And again, I've worked in the central bank for most of my life, and I've seen this, and I've worked in many developing countries where you can see this even starker, that there is clearly, currently, a huge mismatch between you know, the current regulatory system based on Basel, which is absolutely incomprehensible. I mean, I've lived through Basel 1, 2, and 3, and as you know, the pages is just racketed on. And many of you certainly know about the books by Morgan Wicks, The Money Problem, but he raises this very clearly in terms of, you know, we need to do something with the system, otherwise it's just collapse. It will just collapse, quite obviously. Thank you.
Okay, I think, how's this thing?
You're on.
Okay. If you can't hear me, let me know. There's no Purple Heart Award for sitting through an incomprehensible answer.
There should be, though.
I gotta deal with several things tossed. I will have to tell you, I was working around at the time Dodd-Frank went, but I'm not absolutely sure of the distribution of money to Dodd and Frank. What I do quite vividly recall is I think it's Michael Hirsch's great article on Goldman Sachs and Frank. And Dodd actually, toward the end, my memory of this was actually trying to write a much better bill. They could see that the House bill was pretty lousy. I can't, I mean, there's a couple of books on this. I don't think they do justice to the what shall I call it, the green tide that is flowing through that. And the New Yorker, I think, they presented their rosy view of Barney Frank. But that's, I think Walker might speak to that. So I gotta duck that. Beyond that, I gotta duck it. On the question of, okay, general question, how do you deal with this? The first thing to be said is, I think, it is, as implicitly it's in your remark on the international system too, it's now crazy. And I have to say that it is not helped by the mass media, which almost never cover until after the event. You know, like, I mean, I remember when one of the major papers, I think it was the Washington Post, was talking about Jamie Dimon calling around on the swamp push-up, but my memory is most of that stuff came after the bill passed. There is nothing, I mean, if you look at the way politics is covered in the United States, you will see that all the major newspapers are doing these statistical sections where they give you graphs, charts, and endless amounts of money on, endless amounts of money is spent on analyzing polling. But curiously, they can't bring themselves to say anything meaningful about political money. And, you know, I don't think that's an accident, frankly, and there I'm not entirely guessing. But anyway, I would observe, when do you actually get real movements to check banks that are effective? When you have a powerful social movement that really concentrates on it. The New Deal is one obvious example where things worked rather for a while. They didn't work all that long, though the legacy of that regulation, until you moved to deregulation in the 70s, prevented a lot of nonsense. But, you know, the European-U.S. differences are in the process of breaking down. I am not guessing. I know what I'm talking about. In the past, you had like hedge funds being approached by European regulators. This was before Barroso, saying things like, well, look, you know, let me put my money in your fund and I'll tell you what's going on. I know a lot. Things like that. I think when Steinmeier ran for the, as the head of the SPD, the likely future chancellor candidate, all the speeches came out. You began to learn there about how social democratic parties break down, they lose control of their top folks. There's a wonderful book, Labor Party PLC, which I seem to be the only reader of that in the whole world. And it walks you through how the British Labour Party was sort of carved out from inside as Blair came up by firms like BP and others. It's a really terrific study. That's why when I read Julia Caget's paper on the French elections, I was so interested to see she got the same linear model. I mean, she showed me her first draft, and I said, this is a linear model struggling to break free. You should actually run it. And she told the whole audience later at a conference, well, I didn't believe him, but it's true. It is. Yeah, you can read the paper. It's up on the INET website. It's no problem at all to read. This is a serious problem. I actually think that, again, I repeat my basic point from the very first, it was the first draft. The fundamental problem is, as social inequality gets to crazy levels, the population loses control of the government. It almost doesn't matter what the special rules are, how you box it in, or any of that stuff. My only comment on Thorvald's big point there, I want to underscore what he said. Because he's Norwegian, I think he was polite and friendly. Look, if you do a public option for banking, you can take away a lot of the rents banks now enjoy. When I just checked just before we went to talk, and I'm finding something like non-interest income, 40% of that is coming from, in banks, now about 40% of that in the big banks is coming from customer fees. Now look, folks, this is a ripoff. This is a monopoly. And you can end this if they have, if you had, say, a deposit, an exchange account that you could use for make payments right at the central bank. It has to be, I think, the central bank, because otherwise your inside the day stuff will not necessarily clear. You can't, that's the little corner of private banks with endogenous money, which is the real world, as folks at the Minsky Institute have been saying for ages, long before it became fashionable. Have always realized. But you actually now, in that respect, cryptocurrency is, whatever it is a whole lot less interesting then the possibilities opened up by the electronic revolution. The scary part of that, as any number of Chinese have pointed out to me recently, you take a thing like Alibaba, which has a gigantic payments operation, and then they are in the process where they abolish the traditional distinction between trade and, or pardon me, commerce and industry, so that they're sort of in effect a giant trading company with a bank so big in themselves that they can make many payments in the country just in and out of various parts of them, and now they have a giant big data capacity. I mean, we are moving, if you want your bank to know everything about you, you know, even the American banks as they exist are scary. I would observe that since I pay attention to this, the American political part, we've been hearing a lot about how, you know, Russian this or that may have your data on Facebook. You know who else buys data from Facebook? The American political parties. People who've worked with those data sets tell me that in many cases your whole credit card payment stuff is already in there, you know, and that is not Vladimir Putin.
All right, so I'd love to just move on to some questions really quick. I'm sure we'll maybe take three at a go, and then move on to the next round. So 1, 2, and there's a gentleman back there, 3. Why don't you start? There's some microphones coming around, so just wait for the mic. And maybe you can identify yourself and where you're from. That might be helpful too.
Hello? Yeah, I'm Thorvald. A spoke this morning, but B, actually, I used to work for a group that I guess was called a bank lobbying group. So I actually spent a lot of time in 2010, 11, 12 working with regulators, arguing against them on regulation. It was actually a famous meeting where Jamie Dimon and Mark Carney screamed at the top of their voices at each other, and Mark ended up walking out. So a lot of drama queens and all that on this issue. And I'm not sure what I really think, but what I'd like to do is just ask each of the panelists, really there are two sets of issues here we're talking about, which is, to use IMF speak, it's crisis resolution and crisis prevention. And Walker spent most of his time talking about crisis resolution. And there, my basic question to you, but maybe the other panelists want to answer it as well, is my actual impression is we did rather well in 0809. In other words, we could have had another Great Depression, but we didn't because we had very good, agile Fed lending. So am I getting, you know, is that view wrong? And then maybe on the crisis prevention, which is really to the other two gentlemen, I guess, is on the sort of broad issue of Dodd-Frank, isn't it a case that it's such a complicated thing, we were bound not to get it right? So you need reform of Dodd-Frank to get it right. Or again, am I getting the wrong impression? And to Mr. Moe, Dr. Moe, is it really, you know, are we looking here at cryptocurrencies, I think you alluded to this in your talk, as really the source of the next financial crisis? Because in a sense, they allow us to get around all this great regulation that we've been putting in place.
Okay, we'll wait for the next. We'll round up all 3 questions. So there was another back there, or maybe just this there. Oh, I'm sorry. I think we forgot gentleman over here.
Oh, thank you. My name's David Nissen. I took Hyminski's money and banking course in 1962, and I was his RA at Berkeley. And while I've been an energy economist all my life, I've been puzzled by practices in this kind of industry, and I want to ask a question about the following issue. Because it's so contrary to what I learned back in the olden days when the provision of reserves was supposed to then lead to a multiplied money and credit expansion. The Fed, the commercial banking system started exhibiting excess reserves in 2008, and it's now $2 trillion on change. I hadn't really understood how this could exist in an equilibrium where we are worried about deficient capital formation and wondering whether it's caused by deficient funding. But I just looked it up, and the Fed pays 1.75% interest on those reserve accounts,
which amounts to $35 billion a year, and which forces corporate borrowers to compete against a risk-free asset that pays that yield. And I can understand why that might have happened in 2008, when you were sort of starting a whole QE world. But I don't understand why it exists today. It seems an insane waste of funds and a deterrent to capital formation. That's my question. Why are we doing that? Or should we quit?
Okay, great. Thank you very much. And then right here.
Hi, my name's Deepak Ahuja with MODERATOR Investments. This question is pretty specific to, I guess, Thomas, you mentioned earlier on, the growth of offshore derivatives, and everyone's moved. The growth of offshore derivatives have been moved from basically onshore to offshore. If you could just walk that through for us, kind of what the significance is and the history and where it's going, and kind of, derivatives played a part in the collapse in 2008. If you can just kind of elaborate a little bit further. Thanks.
Great. Thank you. So just to start, we had crisis. The crisis, did they do so bad in the bailout, preventing the second Great Depression? Does Dodd-Frank need a reboot? And is crypto the source of the next financial crisis? So we will start with you, Walter.
Okay. On the first question up here about didn't we do a great job in '08? And the answer is the older guys here, you all remember Douglas MacArthur, World War II. What is the standard critique of MacArthur, who was a military genius, and he could devise great battle plans? Standard critique of soldiers who served in the Pacific is MacArthur would win battles while losing 40,000 men, and the same battle could have been won losing, say, 10,000. And in the aftermath, the public is saying, wasn't it great that we won? I guess we did the necessary thing. And that's how I react to the great job we did in 2008. Those clowns refused to read a single word written by the veterans of the 1930s about how they got out of a worse crisis. Jesse Jones's book, $50 billion, was out there circulating. I think he read it. And the question was, did, for example, the principal law firm that represented Goldman Sachs and others in that crisis know about what was actually done in the 30s? Yes, because I have sat there with their senior partners and had extensive discussions about it. They knew the story, but Tim Geithner didn't know the story. Hank Paulson didn't know the story. And Ben Bernanke didn't know the story. And they refused to learn. And the reaction I always got when I raised this point was, well, the Obama administration were coming in, we're all about hope and change, positive feelings. The 30s, the Depression, it's such a downer. We don't want to go there. Okay. The point over there about the way the world has changed in discount window lending. What was the last key question, shall we say?
I think it was, why are we doing interest on excess reserves?
Oh, interest on excess reserves. Yes, I have written articles about that. They've been published. In fact, Levy Institute published one of my great ones in, I think it was 2012, maybe as late as 2014, somewhere in there, describing an experience I had going to a conference in Switzerland that was full of bankers from the Swiss National Bank. And in the breaks, they would come over to me and say, why in God's name are you guys paying interest on excess reserves? And I said, indeed, I asked that same question and I never get a good answer. And the answer the Fed would give you is we have to do it in order to hold those reserves locked up at the central bank. Otherwise, they'd be out there stimulating bank lending, investments. And if you think you got asset bubbles now, wait till you see what would happen, and there'd be so much inflation, we have no choice but to pay the excess. And the right answer to that is shrink the balance sheet, let it shrink naturally, the Fed is resisting natural shrinkage of the balance sheet just from maturing obligations, and instead it's rolling them over, at least partially. And the Fed, if it would just tolerate natural shrinkage of the balance sheet, it wouldn't even have to raise rates. A good exercise is to go out there and find out how many other major central banks in the world have raised rates at all in the last year and a half. The answer is about 8. The only ones that matter are us, Mexico, Canada, and they're sort of our prisoners. They have to do whatever we do. The UK went up 1 time, I believe, 1 time only, and all the others are named Turkey, Russia, and places like that where there's a story underneath it. So why are we raising rates instead of shrinking the balance sheet? And why are we paying interest on excess reserves? And the answer is political muscle, money. And the last question there on the derivatives, when it moved offshore, was it still within the insured bank, as in foreign offices of branch offices of head office, as opposed to obligations of a separately chartered local subsidiary?
Okay, I don't, look, on the specific question about derivatives, this is a case I'm going to leave the smile of the Cheshire Cat. We are actually at INET about to publish Michael Greenberger's piece. I've read it, I edited it, and I frankly think it's his piece, so I'm not going to try to grab it. Watch, this metaphorical space soon, you'll see it. But, look, bluntly, derivatives, not repos and things, are what brought the whole system down. That's the complex element where, in effect, they all get linked together, and somebody's inability to pay causes panic in the repo market. And so that's the thing you want to keep your eye on. And the short, blunt answer is actually that situation is still terrible. Now, I'm actually going to have to leave in about 5 minutes, I regret to say, so I will just tell you, if I could very quickly, my answers, and then in the sort of great tradition of the Parthian volley, I will have to split, I regret to say. The complexity of the bank reform is actually quite endogenous to the system. Bluntly, banks are not stupid. They do, like lots of other interests, when they're on the hot seat, and they were on the hot seat in 2008 and 2009, the trick is to do as little as you must, then kick as many decisions down into the future, typically into congressional committees that literally weigh envelopes sometimes. They're members. And so, they were largely responsible for those endless number of rules that they were told to produce. It's actually in the hundreds. This would not happen if they did not want it to happen. It wasn't the public that didn't want, or public interest lobbyists. I know I was one in that tiny number, as were a few other people here. It's not like we wanted to kick the decision down on one thing after another to 2, 3, 4, many years later. That's a delaying tactic, okay? Now, let's see, so complexity, and look, my sort of parting remark here is that people have been congratulating, bankers have been congratulating themselves on how the world was saved in 2008, but in fact, really only the banks were. I've seen several detailed studies now. I think, could be wrong on this, one was by Barry Eichengreen and several people, where they just compare the recoveries in about 10 or 20 countries, and what you see is actually, believe it or not, by 39 or 40, you were back even in the US economy to the income you had in the late 20s. Now, there was no mystery about that, and it wasn't always policy except the approach of war and the decision to fund, to allow exports out of the US to potential belligerent countries, and also to do some U.S. preparations. I think Robert Gordon has said everything there needs to be said about that case of recovery from the 30s. But many countries today are still not anywhere like where they were, not in Italy or Greece. Big chunks of the United States. You know, basically, I recall a well-known columnist saying we really should be so happy in 2016 that President Obama brought us back, we brought the economy back. Well, you know, if you viewed that, if you thought Obama really had brought you back, you were very likely to vote for the person who was claiming to be his residual legatee, and that was Hillary Clinton. But if you disagreed with that, your chances that you voted for Donald Trump were something like 70%. It was huge. And so I'm not telling you that only economics factored in the Trump victory. I am saying that all the ratatate about how great the recovery was is mostly nonsense. And if you will do something besides, did the banks fail? Or did bankers fail to get their bonuses, you know, which after all, in most cases, they did get bonuses. Even AIG got bonuses there. You know, then if you have a somewhat stiffer criteria for recovery, it wasn't, you know, it wasn't just a blunder, it was a crime.
Very briefly, on the cryptocurrency, the source for the next crisis, I don't have the figures, but you know, I mean, there are a lot of them out there. But I think G20 is correct when they say that you know these are not yet of a magnitude that there is anything to be concerned about. I think what I was alluding to is that they may be more of a symptom of a more wider access. Which is engineered, I mean, by low rates and people running into risky assets. And I'm much more concerned for, let's say, pension funds than I'm for the crypto space. When I have the mic, just a short comment on Walker here and then our last resort. And the background is that I actually worked there for a year and did a paper on shadow banking back then. And there is a question that there are two questions. One is, you know, did we the right thing in 2008 or not? And we can debate that. But what I'm more concerned about is the development since 2008.
Yep.
And I just came from a conference in Oslo where I was commenting on a paper on repo market finance and the development there. And where you can see that there are central banks now embracing the notion of a wider sort of role as market maker or last resort. And some of you might have read Perry Merling's book, Lombard Street. And the idea here is that, well, you know, we shouldn't do firm-specific rescue operation, as is prohibited now by Dodd-Frank, but we should be open to and embrace a role for central bank as backstopping key markets. And my, actually, I just quote my conclusion from that paper, which is that central banks have pledged not to use taxpayers' money anymore to bail out systemic banks. That's the too big to fail conundrum. But why should they then commit taxpayers' money to underwrite systemic markets? And that is what they're actually up to now. So we should be concerned about that. Thank you.
That's great. We'll have a few more questions and just a appeal. If any, we've had a lot of male voices. If there's any women out there who want to ask some questions, that would be wonderful. But if not, we'll take whatever else. Gentleman over there, gentleman over there.
Yes, I would like to ask Professor Todd about the 10th anniversary of Bertrand's failure, and was it another example of how a bad, let's say, bailout of financial institutions can unfold? And to Mr. Thorvald, I would like to ask about cryptocurrencies that you said that they're not like currencies, and so they're more like assets like corporate stocks maybe, no? And is there any chance that central banks are going to include those crypto assets as in the range of eligible assets eligible for collateral of the window in the next future? Thank you.
Okay, gentleman over there.
I have an opportunity to ask two bankers, one in New York and one in Europe. and that when the Germans, let's say the Deutsche Bank people came, they demanded to see their gold. The question is, how much gold does the United States have, and what relationship is the Federal Reserve to propping up the euro?
Okay, so, how about it?
And that's essentially your question too, right? That what is the role of the Fed going forward with respect to the euro and central banks abroad, right? Is that right?
Oh, what, sir?
No, he was asking about cryptocurrencies as
Yeah, I know.
at the
We
window.
have two questions.
Oh, yeah.
First
What was the first
about
question?
Bear Stearns bailout. The Bear Stearns bailout.
Which
Well,
bailout, I'm sorry?
The Bear Stearns
Bear
bailout.
Stearns,
What
yeah.
was, what exactly about it?
Okay, I just published an article, Tom has left, but it's on the INET website, ineteconomics.org, on the 10th anniversary of the Bear Stearns failure. So if you want to read about it, read there. I wrote it up, and it's a pretty good article. But anyway, that was the first step on the path to hell. It was done in the dark of night. I quoted a line from Macbeth where Macbeth is addressing, I think it's Banquo's ghost, and he says, "Thou canst not say that I did it. Thou shake not thy gory locks at me," meaning you can't say that I killed you, you know. How do you prove it? And so the theme of the article is preserving plausible deniability is primum bonum in Washington. It's what everyone wants. And so, as usual, the Bear Stearns loan was done in the dark of night and through various covert mechanisms initially. The key crunch time was it required 5 governors to vote for it, and there were only 5 governors at the time, and one of them was in Helsinki, Finland. And so the question was, how could he sign the relevant papers? And the answer was the 4 who were there declared they had the authority to sign it anyway. They signed, the loan was made, and then when the missing governor arrived the next day, he went over and ratified it by signing. So the Fed lent the money first and got the relevant signature later. And I asked a commercial banker in my hometown, what would happen to you if you did that for a customer? And the answer is, I would either be reamed out by the bank examiners or I would face criminal charges or both. So, you know, it's a bad scene. On the Gulf War and the Euro generally.
Maybe let Thorvald answer your question about crypto as an asset that could be pledged at the center bank.
The short answer is no, I don't think so. But it is a more general question that we've touched upon, you know, the whole panel here in terms of what is the eligibility criteria for collateral at the central bank. And I think, you know, when I wrote about this some time ago, I quoted Paul Tucker, who said that central banks' collateral policies are indeed endogenous to their objectives. So if we talk about, you know, saving markets, you know, they can declare that, you know, they won't take this and that for collateral, but when, you know, the crunch comes, they just have to accept whatever you throw at them, and then maybe they will throw cryptocurrencies on them as well to save the market. Who can tell?
The gentleman over there asked about the role of the Gulf War and the propping of the
Gulf War
euro,
and then the
No,
euro.
well,
and also the Fed's role in propping
Yeah,
of the euro.
I can address that, but I don't know much about gold. But I want to make a remark about the Fed's role in propping up, not necessarily the euro, but foreign banks. I've written a paper on this as well, in the context of, you know, who could, you know, replace the Fed if there is a new crisis, and you know, in my case, you know, whether the IMF could have a role. And I think they can't, because, you know, the demand are too high. I think the key problem, and the BIS, by the way, have written beautifully about this, is, you know, the extension of dollar credit abroad by banks in non-dollar countries. And so you have a situation which is very complicated and relates to supervision, who has responsibility for branches and subsidiaries and stuff like that. But the basic thing is we have a world economy where, you know, banks are allowed in non-US countries to issue dollar loans, you know, willy-nilly, and nobody asks them whether they have backing for that until you come to a crisis, and the only one who can backstop them is the Fed. So even though, you know, the president would say that this is not your business, you know, they simply have to, otherwise the system will go down. Thank you.
Okay, one last round of questions. Oh, sorry, did you want to make one more comment? I'm sorry.
Yeah, on the right thing. I've written elsewhere that the Fed should not lend to any entity that it does not examine. And so that's sort of it. You're entirely right. That is the problem with these dollar loans out there. The Gulf War, I think they were parallel tracks at the time back in 1991, giving rise to the euro, so I don't think it was a cause of it. Gold in the system, I think we'd be better off with gold in the system just to tie the hands somewhat of the central bankers, because once you reach the limit of the gold reserve, you have to stop. And I'm just looking for anything that will stop the central bankers from making these bailout loans. For saving the financial markets, the right answer is the point I was making toward the end of my talk. The right answer is appropriations by Congress. You want to save the mortgage lending market? Then go stand up and manfully or womanfully vote for such a measure and take the political heat for doing so. Instead, everyone in Washington likes to point at the Fed and say, you do it, because there's no political accountability. And that invokes my Macbeth quote again.
All right, so, yeah. I think there's one last question.
Just a quick one. The proposal for a cashless society in the Nordic countries. Would that ever have come to this point if you didn't have the protection of your private data for citizens there? Is that involved in the discussion?
The privacy rules are there, and they're actually been strengthened just as we talk in the EU. But I should also add that the program for cashless society was not an explicit program as such, but it came about, for example, by the way we in the central bank started, you know, pricing cash. You know, so actually cash for the commercial banks became a very expensive operation. And so, in fact, you know, we sort of outsourced all of the cash handling, and as a result, we could say endogenously, the system has you know, converged towards almost cashless. So it hasn't, I think, been just by design. But again, I mean, the anonymity issue is clearly there, and as was alluded, you know, and if you look to China, which is quite active in thinking about issuing digital cash, there are some scary aspects related to this. I mean, it's almost like you go back to the Soviet system of the Ghost Plan system, where everybody had accounts and everybody, you know, was monitored, and you know, you sort of wonder, well, you know, what's going to happen. I think, if you want my prediction, I think there will be a hybrid system where you would be given the option of holding central bank money on token, on cards or something, up to a certain limit, anonymously, and beyond that, you know, you can hold them, but then they would be traceable.
Okay, Walker, I cannot let you get off that easily on the constitutional problem. We know that. Okay, we know that the Constitution says nothing about the incorporation of banks or a central bank. Okay? It also reserves to the federal government the right to issue notes and coins.
Right, there's a congressional power.
Okay, so there is one contradiction. I would have, you have to resolve. How do you propose to resolve that problem?
Oh, the
One-
Treasury, well, go ahead.
Yeah, okay. Well, there are two possibilities that come out of this. We know that the states have claimed the right to incorporate banks as a result of the absence in the Constitution, which means that there is a possibility that the U.S. could have had a central bank which was a private state bank. And this would have followed the British example or the Italian example or a number of other examples, all of which eventually ended up with these private central banks being nationalized and becoming either federal or state banks. So it seems to me that there is a sort of an inherent contradiction in the way the Constitution has been set up and the right or the non-right to create a central bank. Now, we also know that after the '07 crisis, the response was to create a mechanism of pooling of reserves. So the proposals for the U.S. were some sort of reserve association. And the reserve association implicitly did what? Implicitly it said that we are going to have some sort of lender of last resort function, because that's what a reserve association implicitly does. So that when we ended up with a central bank that was really not a central bank, it was a reserve bank, by definition it was something that carried out discount window lending, because that's how you do reserve distribution to the banks. So there's again a contradiction involved here in saying, well, we have a central bank which is really not a central bank but is a reserve association that by definition can only function by means of granting reserves against collateral. And as we know, it only took the experience and the change in the 35 bank law in order to get us into something else. So now I would like to push you to the point and say, well, there is no right for the Constitution or the government to create a central bank, but number one, no matter how we look at it, it ends up that way. So what do? Do we say we get rid of the central bank? Do we put it back in the right to issue notes back in the Treasury? And implicitly, if we believe that reserves are an important source of providing stability to the system, is it sensible to get rid of them? Because in fact, the kinds of open market operations we do not do the same thing.
Yeah. Very good set of questions. Number one, on who would do it if we didn't have the Fed, the Treasury would do it. Between 1837 and 1913, there was no central bank. Guess who provided the currency and payment system functions and so on. So the Treasury could do whatever limited central bank operations the reserve associations, clearinghouses, and the like wouldn't want to do.
And this was a trick. What was Timothy Geithner in the crisis?
Louder, please.
What was Timothy Geithner
He was head of the Fed of New York during the crisis.
And then in the recovery, in the creation of the...
And he then became the Secretary of the Treasury, and he was there during Dodd-Frank. He was the Treasury guy on Dodd-Frank. On that role of the clearinghouse associations and the reserve associations, in the aftermath of the 1907 panic, the clearinghouses were given the authority in an emergency to perform what we would think of today as discount window lending operations. But the key was it was reserved for emergencies only, not a routine daily operation. And the bankers decided after 1912 that they wanted a permanent facility like the one that they were given in '08. But what was your following? But again, the question was, yeah, they kind of slid from the private sector operation or state chartered licensing. And I think you're right, by the way, that had there been no Central Bank of the United States, say in 1791, that they would have chartered it in Pennsylvania, and it probably would have been the same Bank of the United States, but it would be operating under state charter. And so then that begs the question, what would happen by mid-20th century when all these entities were sliding into national control, and we would have had no constitutional authority to do it. We might have done it anyway, but it would be extra constitutional. The point is that don't argue that it's constitutional. It's not, okay? The reserve associations or clearinghouses could perform a lot of these functions if the Fed went away, and I foresee a future in which that would be happening. Clearinghouses with loss-sharing agreements would perform a lot of these functions. The Treasury would perform other functions, and if an emergency came that required a bailout, you would go to Congress and say, recreate the Reconstruction Finance Corporation, not this weak-kneed version that you called TARP, and that was essentially a banker bailout fund.
But you remember, in 1914, in fact, it was not the Fed that provided the support for the system. It was the leftover of the Reserve Association.
That is correct. The Reserve Associations, the private sector entities, as it were the key players performing these functions in the years running up to the creation of the Fed. And the Treasury stopped doing its central banking functions in 1922 and gave it all to the Fed.
Okay, I guess we have one last question.
First, you bring up the state issue. Andrew Cuomo has now dedicated 15,000 megawatts of power out of Niagara Falls. Where would the Bitcoin be without electricity? And would that be the creation of a state currency not based upon gold or silver? That was my first question raised by this issue. You bring up the emergency requirement, 1907. That, the 20 years that was to expire in 1933 was changed by I think Calvin Coolidge with the perpetuities law, and that in fact there was a permanent emergency installed on, we're in the 85th year of the Emergency Banking Relief Act. We remain in emergency. The Constitution is suspended under Proclamation 2040.
Yep. Okay, but yes, if you get a copy of the Federal Reserve Act as a statute book, it still has that 1908 statute in it that we've been talking about. It is still good law. In other words, suppose the Fed just said tomorrow morning, we're shutting down, I'm sorry, we're going away. And well, what would happen? And the answer is that 1908 statute could still be invoked.
And regarding the electricity, I think I'll pass that one, except to say that Bitcoin is using enormous amount of electricity because there is no central, there is no central trust party. So, I'm not sure whether that's very environmentally sound, and I think I'll leave it at that. Thank you.
But they're doing it in northern Norway.